Hi dear traders. Traders have been waiting for the crucial event since the end of last week. We are talking about the release of the US inflation data, which will certainly influence the Fed's decision regarding the interest rate policy. An increase in the consumer price index could pave the way for a rate hike at the Fed's November meeting. Such speculations boost demand for the US dollar in the foreign exchange market. The US dollar index, which measures its strength against the basket of 6 major currencies, closed the previous week above 105, marking its 8th consecutive week of gains. The possibility of a rate increase by the Fed was further boosted by strong macroeconomic data from the US. For instance, the number of initial jobless claims was at its lowest level in the past 6 months. Additionally, the ISM report recorded a rebound in the services sector, reaching a 6-month peak. In the meantime, in Europe, the economic situation is quite the opposite. With a decline in economic activity and a looming recession, the euro dipped to its lowest level in 3 months, hitting the mark of 1.0700 against the greenback. Investors widely expect the European Central Bank to keep its monetary policy unchanged during its meeting on September 14th. Meanwhile, inflation rates remain steady at 5.3%, more than double the central bank's target. The ECB's recent communications about its intentions regarding interest rates have been somewhat ambiguous, creating uncertainty about its upcoming moves. The British pound also couldn't resist the dollar's rally. The pound-dollar pair fell below the key level of 1.25 for the first time in the 3 months. The British currency saw significant selling pressure after Andrew Bailey, the governor of the Bank of England, addressed the nation's parliament. Bailey indicated that the central bank is nearing the end of its series of rate hikes, although the need for further increases remains due to high inflation. The current interest rate in the UK has already reached a critical level that might adversely affect the economy. In the past trading week, the dollars-yen pair once again attempted to breach a 32-year high, approaching the mark of 150 yen per dollar. Notably, in the fall of 2022, the Japanese authorities conducted a currency intervention when the pair hit this very level. Investors continue to favor the US dollar, considering the difference in interest rates between the two central banks. While the Federal Reserve keeps the rate at 5.50% with potential future increases, Japan's rate remains in negative territory due to bolster its economy. However, the new week commenced with a statement from Kazuo Ueda, the governor of the Bank of Japan, who expressed intentions to end the era of negative rates once inflation hits the 2% target. This comment encouraged the market, leading to the yen's uptick at the start of the new week. All speculations concerning interest rates directly influence gold prices. Despite this, the precious metal managed to hold above $1,900 per troy ounce. Meanwhile, oil traders roped up the week, leaving Brent oil at its highest level since November as the price surpassed the $90 mark. The bullish sentiment in the oil market was fueled by traders purchasing the asset amid the extended agreement between Russia and Saudi Arabia to voluntarily cut supplies. Additionally, a consistent decrease in crude inventories in the US further bolstered this bullish outlook. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!